How are you today?
Good. How are you, Dennis?
Very good, very good. We've got getting started. Sorry to everyone that joined that we got started a little late. Um, this is our first webinar, so working through all the technical details as well. Just for our
I
audience
understand. I
out
understand. No
there
problem.
listening, if you have questions, please enter the questions right into the Q&A panel, and we will, or the chat, and we will grab them, and I'll ask them to Steve at the end of our discussion here. So, first of all, I'd like to introduce our guest today. Uh, I'm excited that Steve's joining us. He's currently the president, managing member, and co-head of alternative investments at Shepherd Kaplan Krochuk. Prior to joining SKK, he spent 16 years as the founder and general partner of Ironside Capital Group. In addition, he serves on the boards of numerous companies, including Provident Healthcare Partners, Trilio, NanoDX, and Trellis. And he has been a board member of the American Red Cross for over 20 years. His list of accomplishments and credits goes on and on and on. I think we'd run out of time if we went through them all, but I think I would be remiss if I did not add that he's also a proud Bates College alumnus. So, without further ado, thank you, Steve, for joining us. How are you today?
Good. Good, Dennis. Good to see you.
So, I wanted to get started in talking about this rising wave of alternative investments that we hear more and more about in the media and in our industries as we're talking. But alternative investments aren't new. What are the trends that you're seeing in recent years that have caused this alternative wave start and take place?
Well, listen, I think alternatives been around for a while, right? They started, the mid '50s, mid '60s. We were lucky to be here in Boston, where I like to credit the founder of alternatives to be Peter Brook, who started several companies, not only Greylock, but TA and Advent. Um, but that was when people used to get together, basically find a company that needed capital and form a syndicate together. This is basically sitting around the table. How are we going to help this company move it forward? And then throw a shoulder into it, right? Actually not just invest and be a passive investor, but actually sit on a board, sit on a committee, try to bring some value to the investments when you make them. And that's continued to grow. That I believe that thirst to fuel entrepreneurialism, not only in the U.S. but all the globe, has just continued to grow, and it's gotten to be an asset class that is a must-have as opposed to a need-to-have in portfolios, whether you're a large institution or whether you're a family office or an individual investor. So the appeal for alternative investments has grown, I think, for a lot of reasons. One, alternatives really provide investors, especially institutions and families, and then manage capital through an advisory firm, an RIA, or a managed family office. A nice hedge against the markets, hedge against volatility. It's a nice volatility dampener. You can avoid a lot of the market fluctuations and volatility you see. And then you look at the correlation of standard asset classes to each other. This is a kind of a non-correlated asset class, and as it's continued to grow, smart people put together unique structures to take advantage of different types of investments, different verticals, right? So alternatives started out as kind of not really started out, but private equity venture. It was this kind of nebulous place where people could invest with really smart people who could go out and find the best companies and try to grow them and sell them, to take them public when the public markets were really available back then, or the exit of choice, or to sell them in trade sales. And that has continued to morph. A lot of VC firms were formed, a lot of private equity firms were formed, very, very smart people doing unique things. But then it started to become a little more mainstream, at least in the last 10, 15 years, it started becoming mainstream. It was a place where institutions invested. It was a place that was really not available to individual investors in a large way. And again, that's continued to grow and expand because people went out and ventured to build a firm, build venture funds to create access for different types of investors, individuals as well. And now you've got all kinds of different platforms that are out there, crowdfunding, and you've got a firm like Republic that's out there and providing kind of the everyday investor an ability to invest in companies at every level, right? Early stage to growth, $10,000 to $1 million. So it's become, but I think at its core, I think the same virtues and the same values of alternative investing really exist at the core. It's you're trying to do the right thing by clients. You're trying to provide them with on the margin yield or even outstripped yield over and above their other allocations in the market. It should be seen as, in my opinion, as a complementary asset class to a sound investment portfolio that's put together for clients. We have a lot of family offices here at our firm that we manage money for, and we try to advise the right way. And alternatives just provides a nice opportunity, again, to do what I said before, lower volatility in a portfolio potentially, increase potential returns, create additional diversification in the portfolio. And a lot of people like that. A lot of people like to have a direct investment in a company, or they like to have an investment in a longer dated asset with great upside potential without having to deal with the fluctuations in the market swings. So I just think it's a combination. People have realized, and we now have a large enough data set to show the return scenario and the return analysis of private equity, venture, and alternative assets as compared to public equity and more traditional asset classes. So there's a comparative analysis that people can see, and this is covered by Preqin and all the other tracking services. And then there are other platforms that have actually made it more accessible for the larger population of investors out there. And whether you're accredited, you're a qualified purchaser, whether you're Yale's endowment or an RIA in Boston or anywhere else in the country, I mean, there are opportunities for you to take advantage of alternatives now, which didn't really exist, 30, 40, 50 years ago, the way they do now. So I think that's created a lot of popularity.
So that's a really good point, bringing in how access has changed, which has really grown these. I think you talked. My next question was going to be, what are the advantages of alternatives? I think you addressed a lot of that in the last question, in your answer there. What are the risks with alternatives?
Well, yeah, any investment comes with risk, right? You have to try to understand what you're investing in, or you try to hire good advisors that can understand, first of all, your risk profile as an investor. This happens at the institutions all the way down. But to really understand what your risk profile, what's your volatility, the pension for volatility, what's your duration risk profile look like? What's your cash flow need? What are you looking to achieve in the short and long term? Because people have to understand that these are private companies, and depending on the stage of investment you make, whether you're investing in a seed stage idea with some people that or people that might have been successful in other businesses, sold a company or two, or now starting a company from scratch, and you want to take that type of risk. I mean, a lot of people do. It's a great space to invest, but you have to really understand what you're doing. And I think alternatives in general, being able to diligence alternatives and private investments, whether they come in the form of a real estate investment, or they're a hedge fund, or investing in a new technology company. It takes work to understand the vertical you're investing in and really the domain you're investing in. It's about trying to understand the total addressable market for these products or services, really understanding the management team. I think it all starts with the management team, for me at least, in my experience in the space. You got to invest in good management, and there's always a saying that if you don't have good management, you can have an A technology and a B management team. You're going to have a hard time getting up to the next level. Flip that around. A good management team will take a B technology and be able to turn it into an A technology, or at least have probably a better opportunity for success. So you got to be, to really understand that. That takes time. It takes time to understand. There are a lot of people trying to do a lot of things, especially entrepreneurs. You just have to understand their skill set, and their expertise, and their ability to actually execute on a business model. I think the other thing is you have to understand that the addressable market, because there are a lot of technologies and a lot of investments that have been made where the technology basically ends up on a shelf somewhere because they really got ahead of a market. Maybe they were behind a market, or they hadn't really understood, who was going to buy the technology or need the service. So, again, those are all the traditional risks. I mean, the same risks apply to public investing, but, there's a lot more readily available information about public investments and public securities and companies and funds and things like that, because, at the touch of a button, you can pull down a prospectus on something. Private investing just a little bit more cumbersome. Now, there are platforms. I mean, you obviously work for one a Trellis that's try to make that process a lot easier for investors, not only issuers but also investors. And so we're continually seeing that happen. So investors, a lot more help for investors to look at alternatives these days. But the same inherent risk still exists, where you have to do your homework with private companies and private funds, and really dig in. And I think the one last thing I would say about the risk profile, about for investors, is your research and your diligence just doesn't stop with your investment. You got to continue to maintain your understanding of those investments, because a lot of times those investments come with a second or third round where you have pro rata rights. You have to understand the ongoing nature of the risk, but also maybe you can ameliorate some of that risk with some growth and some additional policies by the company that they're pulling together. Maybe a new product comes to market through that company or something that lowers the risk profile, but it's always there until you actually exit those transactions. So really understanding that, and understanding that it's a process, it's a longer road. Plus, these are liquid investments, right? With the public investments, you can get in and out of stocks all day long if you like. I mean, these are bets that you make for sometimes 5 to 7 years, sometimes longer. I think you have to be ready for that, and you have to have that long-dated investment strategy, and know that those are liquid strategies. Liquid investments are hard to get out of once you get in, because you're making a commitment to the company, and you're giving them your capital to invest in the firm. Once it's in, it's spent typically. So you're then waiting for the company to mature. So that, and then I think the other risks are sometimes, over the years, minimum investments in these types of investments have been maintained at a very high level, really to keep unsophisticated investors out of these pools of capital that are investing in these. And now that you're coming down to smaller amounts, I think when people are making the decision, we'll spread around a little bit of money into a lot of different transactions. That's a good thing and a bad thing. You have to maintain, you have to understand all those and keep track of them all. But that's, spray and pray, as they used to call it, in the market. Not always a great strategy unless you're, looking into a specific vertical that you understand a lot about, or you have good advice. But those risks are all not probably foreign to you or anybody else that would hear this, but they're things you really have to think about even more so with alternative investments in illiquid assets.
Yeah, and I think you bring up an excellent point there of understanding those risks and understanding the information on what you're getting into, and that has been a challenge in the past, is the ability to properly diligence these privately held companies and opportunities. Historically, is the focus to go through advisors, to go through broker dealers, to get in on this? And are you seeing changes in the market where more investors are working directly with the issuers rather than going through either advisors, broker dealers, or directly into funds? I think you'd mentioned before that you're seeing people are putting less into funds and more spreading it out themselves, in a sense, creating their own fund strategy. Is that what you were kind of implying there?
Well, I think, having run a firm before, we had funds and we invested through blind pool funds. That's a great way to aggregate a lot of capital, and for investors who might not have that level of sophistication or the ability to diligence a transaction, or frankly to actually get access to deals. It's a great way for them to invest. And you have a lot of tremendous managers around the country, around the world, that have managed multiple and series of funds over time and have had great success. So that's one great way to do it. The other way is, if you have an advisor, if you have an advisor that actually has created an investment strategy for you, and an investment outlook in terms of 1, 3, 5, 10, 15, 20 years, depending on whether it's an individual portfolio in a state or a multi-generational estate, having them really opine on again the risk profile that you're willing to, the amount of risk you're willing to take, and whether that's going to be a 5% allocation in your portfolio, 10, 15, 20. Again, if you look back, and I think in 21 now, I think I read somewhere recently that in 21, the allocation to alternative for endowments, foundations, institutional investors was somewhere in the 28 to 35% range to alternatives on average, and it was still down around the 5 to 6% for individual investors on average. And again, I'm not saying that's good, bad, or indifferent, but if you have the ability to have an advisor to help you to build a sound portfolio, and then use alternatives as another addition to that portfolio that adds, again, lower volatility, potentially higher rates of return, potentially, but definitely, it's a non-correlated asset. I mean, that's something that, I would suggest to people who might not have made investments in alternatives before, but see it as a value added to their portfolio. And then you've got investors that have the ability or have the risk pension to invest directly in companies, and literally go out. Companies are raising capital all the time, directly, or maybe not even through a broker. Maybe you're in a network, or maybe you go and you actually join an investor network, like Sky Ventures in Boston. There's several of them. There's the Met Circle in New York. I mean, there's several family office groups that you can attend. You can attend meetings. You can hear about new transactions. That's a way to get access to transactions. And then now with social media and with different marketing tools, companies like, again, I keep coming back. I came back before, but I look at Trellis and look at the platform you're building. These are platforms that allow issuers to get to more eyeballs and get to more people who want access. And that just benefits. It doesn't have to. You don't have to invest in everything you see. It's a way to learn about the markets, a way to learn about certain verticals and types of deals and structures before you pull the trigger and actually invest. But if you feel comfortable investing on your own, building your own portfolio, it's another way to invest. But again, I think where we've come to right now is the traditional model of you can only invest through funds, and there's a high minimum to get into funds, and there's a 3 to 5 year investment period, 10-year fund with 2 1-year ups. Those are still there, and they're still very, very valuable, right, to the certain type of investor. But there's so many different other access points now that people can have. And then when you go to the institutional side, if you're an endowment or foundation, I mean, you're getting approached with transactions all the time. You don't have to look for them. As long as you have capital, anybody raising a fund or trying to raise money in an individual company are trying to find as many investors as they can, good, solid investors. I will say one last thing about the market, though. I think that issuers over the last, at least my experience, issuers over the last 10 or 15 years, they've also become smart and very keen about the fact that, if they are a proven CEO or a proven team, or if they have technology that's really taken hold, they're not a commodity. They're actually a gem. And a lot of these groups are going out and really selecting the co-investors in their business. They're really hand selecting, and some people have the ability to do that. And you know what? You want to invest with those people. They're success stories. The chance of them actually having another success is higher than just investing in somebody just coming up with an idea. So you're starting to see a lot of that too. Is that even if you want to get into a transaction, you might not get in because their prior investors that helped them in their last company might be the first people they call, and then you get a chance to maybe come in at the end of the transaction. So again, being kind of in the know, doing everything you can to read about certain industry segments, certain venture opportunities and firms, and how they're investing and how institutions are investing. All people have to do is go back and read Swenson's book if they want to understand how he took the Yale endowment from 5 billion to 35 billion, or $1.8 billion to 35 billion. Read his book, and that's a good opportunity for people to understand what he did and why he invested in alternatives and why that made such a difference in what Yale's endowment looked like. And that's happened across the endowment space. But you also have to look at that and not look at it as an endowment. You have to look at it and say, how can I learn from this and create some tools for myself to maybe diversify my own portfolio and not get too far ahead of yourself in the alternative space, because again, all the risks that we mentioned before.
So one of the questions I always find, talk about diversifying portfolios, but as we get into it, it's harder to diligence and find information. So I'm assuming most investors, I know historically myself, I tend to invest in businesses and industries that I know and know well from my prior life. Mm-hmm. And as a result, I'm probably not well diversified on my alternatives because, I'm not doing things in agriculture. I'm not doing things in real estate. I stay focused. I've stayed focused in technology in the security space, which is because my background came out of the security space. Do you find that most individual investors tend to stick to what they know and invest there, therefore aren't diversifying as well as they should?
It's a great question because you see that a lot of times when people come out of certain industries or they're in a certain industry, like developers, right? Real estate developers. I have uncles who are real estate developers and always say, I trust bricks and mortar. I can touch it, feel it, go and drive to it, see it every day. I like to invest there. That's how I've made my money. Why would I invest anywhere else? I'll just keep investing in that. That's one way to think of it. But there's also cycles in real estate, and I've seen some of those developers get long on a real estate transaction. All of a sudden, the equity's all theirs, and the market turns, and they can't sell units. Blah blah blah. That's a risky strategy as well, to be single siloed or to single focus. You don't want to be too myopic, but you also want to. I agree with you. I mean, you want to invest in things either you understand, you can generate an understanding for, or you have people around you who will protect you and understand those spaces and advise you well. I believe in diversification. I think, I'm not speaking for SKK here, but, we try to help our clients become as diversified and as build as sound a portfolio as possible, right? And then manage that, maintain it, and monitor it, daily, literally daily. And, sometimes it's hard if people, like, again, individual investors, they will gravitate towards things they can understand. Sometimes they'll gravitate towards things that are in a geographic location, or they're in a certain industry segment or whatever, or of a certain structure. They might invest in early stage transactions because, they've made that decision. I'm going to take 5% of my liquid assets. I'm going to invest them as, see what I can do here and have some fun. To me, a more sound approach, would really win the day as far as I'm concerned, over time and in the long run. And having, again, looking at alternatives as a component of your overall portfolio, not the be all and end all and try to swing for the fences. There are a lot of, there's people talk about, use words like unicorns and home runs and grand slams and everything else. There's nothing wrong with hitting singles, doubles, and triples. You hit enough doubles, you're going to force people to third, and then someone's going to come home. Not every deal is a grand slam. A lot of companies will, raise money at $100 million valuation and sell for 250. In my book, that's a win. It might not be a $1 billion sale, but at least that's progress, and you're protecting your portfolio with maybe less volatile transactions, maybe later stage deals, maybe growth stage transactions where you can actually see the light at the end of the tunnel. Again, it really comes down to profile. It really comes down to risk profile. How much risk are you willing to take in your portfolio, your kids' portfolio, maybe your grandkids' portfolio, maybe in a retirement account as opposed to your active investing account? I think it really comes down to that. And once you can figure that out, and sometimes you need help and you need professionals to help you figure that out, then you can start actually taking, making inroads into the space. And then we come back to is, the last part of that question was, how do people do this, right? I mean, how are they adept at diligence? Maybe they are in an industry segment that they understand. Maybe they created their wealth in that industry segment. Maybe they've been in the healthcare industry. Maybe they were a doctor, and they like to invest in pharmaceutical transactions or medical devices or something they know, but they really wouldn't want to invest in hedge funds. They don't understand it. They're not really invested in real estate. Their real estate is relegated to the homes they own. So again, you have to figure that out up front. But I do agree with you that most people like to tend to invest in things they understand. But a lot of times you can actually generate that understanding by diligent research on those companies and being vigilant about that diligence and never stopping. Continue to understand more about that industry segment. That's the way I think you get smart on these things. Also, one last thing is if you understand the competitive landscape that you're investing in as well. If you're looking at one company, make sure you understand what the 10 competitors are doing and what are the drivers that are creating value in those companies. Because then you'll really understand how to value this company and really diligence this company better than just looking at it in a silo and looking at it with blinders.
That's an excellent bit of advice there. Often see deals that look so good, but who else is out there? What are the others doing? How do they fit into the market space? Can they knock the big boys in that market out, or at least take enough of the market share to make their company valuable? That's an excellent bit of advice. We are getting a little bit into our time here, so I just want to make sure our audience knows if they have questions, please feel free to put them right into the Q&A session, Q&A box, and we'll definitely ask them, or right into the chat, whichever one's easier for you. I do want to talk a little bit about it from the perspective. We've really focused primarily from the investor standpoint, but for the issuer that's out there, that's trying to raise capital and trying to find new sources of capital, who to call on, what to do. You've been doing this a long time. What are the challenges? What are the things that you've seen throughout your career and with recent changes in technology that makes it that you'd put out for some advice for some of our listeners who are actually raising capital now?
Yeah, I guess I'll draw on, that's a great question. I'll draw on my experience as an entrepreneur, not only running companies, but also being involved in early stage companies as an actual employee. And then watching a lot of companies and advising them I was in the investment banking industry early in my career as well. And I think for issuers, there's at least an old saying in my circles is that, when you give a CEO too much money, he'll spend it, or she'll spend it. And, sometimes that's not a good thing, right? Really understanding what your company needs, understanding your business model, understanding what the growth strategy is for your business model, and really understanding not just how much money you need to raise at any point in time, but what kind of value is that creating for your business. Sometimes you raise too much money and that forces you to maybe go in a couple of different directions and maybe make bets that you weren't going to make if you were actually cash strapped. Sometimes you raise too little money and you can't actually get your product to the next level because you just, sometimes things don't work when you're in a development stage company or you're in a technology trial. Sometimes things don't work. We say it takes longer and costs more money. You really have to think about that first, because you also have to think about dilution. These are private companies, so your equity is really your only currency at that point, right? So you want to sell that at the right price. You want to sell it to the right people. You want to sell it to the right value-added investors. But you have to really price those rounds at the right price and at the right size to make them effective for the company. It's not just about raising money and selling all your equity up front at a low valuation just because now I've got a big checkbook. Well, that's not always the best thing to do. Even when companies become mature, a lot of them over the years have gone public for liquidity reasons. And a lot of times you look back at those public companies and they have a nice public offering. All of a sudden they settle down as a single dollar, as a single figure company, and they never grow, right? And they went public just to kind of cash out investors and generate some capital, but they really weren't ready to go public, right? So that's raising capital in the public market as opposed to private. But so I think at the core, the CEO, the board, the management team really has to understand the core strengths of the business, where it's going, what the business model looks like, and then how to actually serially and in a timeline put that business model into effect. And then you fuel it with the fuel you need at the time you need it, right? If you're trying to get from one stage to the next, then you got a new product launch and it's going to cost $8 million to get that out. Don't forget your OpEx. Don't forget your new hires. Don't forget some of the debt you want to take on. Don't forget what it's going to take to actually open a foreign office. It's not just about the technology trial. It's about all the expenses around it. And it was a guy named Alan Gold in New York that worked at Drexel with me, and he always said, people invest in companies and they forget about two things. They go out and they buy a house and they say, oh, geez, I'm paying X amount of dollars for a house. It's not just the purchase price for the house that you buy. It's actually maintaining that house. It's paying the insurance, paying the taxes, maintaining the yard, making sure the security system's in there, whatever, putting a new roof on every 20 years. When you're building a company, it's the same thing. It's not just about let's get the money where we can get it. Now, if it's available to you, take the money. But you dictate the amount and the structure, right? And you try to get that to be agreed on by investors that are going to be adding value to you, and understand your terms. Understand that those are value added not only for you, but also when they invest, those terms will actually help them solidify their investment and actually protect them for the next round when outside investors might be coming in looking for their own rights and their own terms. So it's a science, frankly, in a lot of ways to raise capital for a company. It's not easy. It's never easy for a company to raise capital. But being prepared when you go to the market where you have a story and you have a pitch that you go to the market that is actually tight, very specific about how every nickel is going to be spent over a certain period of time. That's what good investors demand. It's people who don't invest in just hype because you might have an interesting and exciting technology or exciting service or product. People who really understand how to take that company from the time they make the investment to an accretive exit. In my career, I haven't met thousands of people that can do that. I've met a number of people who can do that very well as an investor, as a board member. but not thousands of them, right? So you got to find those good investors that understand your plan and have the ability to actually take it to the next level with you, and use that money judiciously so it gets you to another valuation level for the company, and then go out to the next type of investor that likes to invest in maybe late stage development or early stage growth companies, and give these people a nice bump, give them a fair deal, and then try to take that capital, now grow it 2x, 3x into the next round. Those are all things that, again, it's kind of fundraising 101, but things to remember as an issuer. And I think the last thing I'll say is that issuers are becoming, as I mentioned before, very discerning about the type of investors they want to bring in, because not everybody gets into a transaction and really has the pension for a 6 or 7 year hold. Some people will come to them, especially if it's fund capital, and start saying, hey, boy, my fund's starting to get a little long in the tooth here. You haven't shown me anything in terms of an exit strategy. How am I going to get out of this thing? Because I got to raise my next fund. You got to be careful about those types of investors and creating the right expectations up front.
So you brought up a topic, and I just wanted to ask this question: are there different investors for each stage of the company? Is it common to have the same? Do you keep going back to the same well, or are there 4 or 5 different wells of investors out there? Early stage investors, growth stage, late stage.
Yeah, it's actually pretty defined, actually. They're way back when I was talking about it. I mean, we're not that old, but I remember hearing stories about Peter Brook and the quote unquote generalist investors out there, that would invest in good business plans and good management teams. And really, no matter what industry you're in, you want to invest in a growing industry, an expanding industry, but they'd invest in manufacturing, and then they'd invest in technology, they'd invest in distribution companies, whatever it was. Now it's become much more siloed, almost down to the individual fund within a larger firm that's a multi-funds platform. There are people who really enjoy, it's one they feel comfortable investing at an early stage, a seed stage. They like working with entrepreneurs right out of MIT, Media Lab. They like working with those types of investors, and they like getting in early, and they're typically investing at an extremely low valuation, so they get real value if the company's going to grow. But they want to take that risk, and usually it's I'm not saying it's disposable income or disposable capital. Every dollar is important, but they have that risk profile. And then you got the other end of the spectrum where people will say, look, I only want companies that are actually in revenue, that are in a growth stage. Maybe it's a pre-IPO round, maybe it's a pre-acquisition round. I'll invest there, and everything in between. And it's very distinct. There are funds that only invest in seed stage or A rounds or A to B rounds. They have those bands. Look at A and B or B to C, and each company that's investing in those, that's raising those types of band rounds, has made it through a specific portion of their cycle, and they can actually go out and pitch and say, look what we've done with the last round. Look at the progress we've made. Our ARR or ACV or whatever's going, we've increased by 20, 30%, and that can justify the next round of investment. Then you have another set of investors, and so a lot of the original investors might want to re-up in those rounds. Not to say that they are a growth investor, but they have pro rata rights. They want to maintain those pro rata rights on the original round.
Yeah.
But they'll bring in other people who won't come in until that round, but then they'll put in a larger check at that growth stage, and then they'll take on the financial risk going forward and be able to bring maybe some other value to the table. But it's it's very I believe it's very distinct now in the market, and it has been like that for at least since I've been in the business. I've met a lot of generalists. But we've tended, in my firms in the past, have tended to invest in technology, software services, systems, components. We did a lot of communications infrastructure. We even invested in PCS plays and auctions and spectrum auctions in the past. Right now, we're investing in 5G data in all forms, and cybersecurity on the tech side. A little more eclectic on our life sciences portfolio, but really looking at technology-enabled platforms that multiplex in cancer and injectables and colitis and certain disease factors, and then viral head trauma. They all seem like disparate industry segments, but the platform play, the multiplexing platform play that can literally have 5 or 6 different revenue streams, that's what we're investing in. But again, we're just one firm. There are a lot of other firms that have different strategies. But so for an issuer to find those firms and those investors out there that actually have those focuses on stage, on structure, on industry segment and vertical, I mean, that's part of the challenge of an issuer, is to find those investors that will add the most value that have appropriate capital for you at that appropriate stage.
So, what stage do you prefer? Is there a particular stage for you?
Yeah, well, again, at our firm, we have two sides to our firm. We have an advisory side of the firm with a lot of family offices and investors that we manage their portfolios for, and then we have our asset management business. We've tended to invest in kind of mid development to late development stage and early growth stage investments in those two verticals that we've focused on. I mean, we have, again, most of it's all technology driven, but we've even gotten, as you well know, we have a technology-enabled tech firm, and we've created a fund around the agricultural space. But again, it's all about the technology that's underlying, the investment thesis. But like I said, we'll invest, and this is again looking at your client base, understanding their profile and their risk tendency. And we've asked them, and we've obviously screened all of our investors, and where we're going to feel comfortable for our investors is in that mid to late stage development, really, into a second or third stage trial for a life sciences company or a healthcare company, or for a technology company, maybe in revenue and above, or just about to come out with that next revenue generating rev of your software. So that's kind of the sweet spot for us at this point.
Oh, that's great. Just remind our audience, if there are any other questions that anyone has, please put them in the box. We're coming up to the end of our time here. We've got just about 5 minutes left there, Steve. I wanted to ask a question. So our topic next month, I've got Bill White from ClearList coming on, who his ClearList was set up, one of the FINRA approved alternative trading systems, ATS, that's out there. One of the things you talked about earlier, when the challenges in alternatives is they're illiquid. The alternative trading system, the ATS, seems to be new out there these days. Is that changing is that changing the front of privates? What are your thoughts there?
I think it only can change it if you can make. I mean, you got you have two different areas to invest. I mean, people invest in the public markets, and I think that's a linear market. And you've got basically a bell curve. You have a specific, kind of middle of the road, 10%. I think it was like 10.6% last year, the average returns in the market. And people try to time that, make a mistake, try to time the public markets. They got standard deviations to the right and the left of that that middle of the road standard S&P return. But alternatives isn't like that. Alternatives is a nonlinear return. You've got typical high spikes and long tails. If you're an investor and your situation changes, and maybe you need liquidity, or you want to get you've now held this portfolio or a certain asset or a certain holding for 5 to 6 years, and you want to get some liquidity out of that. Having an exchange you can go to on a blind bid, blind ask basis, and actually sell that, at least market and offer those shares to a market that is ready, willing, and able to actually buy those shares from you. That's invaluable in the alternative space. Never really has been created in the alternative space. So to be able to actually create a similar efficient market that you see in the public markets, in the alternatives and the private markets, I mean, yeah, that's transformational. And I know ClearList has been doing this. I know I know some of the groups that are involved with ClearList. You got some of the largest trading firms out there. You got some of the largest market makers out there. But I think if once people understand it and really take the time to understand it, I think they'll use it just like they use the public markets to sell a portfolio holding that might just be long in the tooth, or maybe has increased in value and they want to get out at the top, or maybe there's a dog in their portfolio and they say, you know what, I want to rebalance a little bit here. It was a good play for a while. I traded in and out of it, but you know what, I want to move that to the side and rebalance. If we had that same ability in the alternatives in the private markets, which I think you do now with the ClearList, I mean, again, that's invaluable to a portfolio manager. It's invaluable to a family that has, again, multi-generational needs, different cash flow needs, different preservation of capital needs, and being able to literally manipulate your portfolio with that type of control on the alternative side. Yeah, that's extremely interesting, and I think that's gonna take hold very quickly.
Great. We did get one last question just came in from the audience about crowdfunding, where we've seen the growth of that, and I know crowdfunding is for anyone to get involved, not whereas alternatives are for accredited investors and above. What's the challenge or the difference there? Throwing people putting small amounts in as accredited investors to crowdfunding. Are you seeing with the rise of technology and changes that are coming in, like a Trellis, what we're doing, where we're kind of trying to bring crowdfunding type technologies to Reg D offerings? Do you think it'll bring about that interaction in play like we've seen with crowdfunding?
I believe in access. In all things investments. If you have access and transparency, and that access can be granted to all investors. You look at some recent legislation allowing retirement accounts to get in alternatives. There's an effort being made to let Joe investor invest in these types of companies. Now you look at crowdfunding. If you just go on any one of the sites, there's a lot of them out there. And you look at the types of investments that people are making, the types of companies that are raising capital. I mean, there are a lot of interesting companies. You got to sift through a lot of companies to find the ones that you feel are going to get some traction. Again, more work, and I think you should do the work, no matter whether you're investing 50,000 or 5 million in these companies. You should do the work. I think these platforms are great ways to educate people about alternative investing and private equity investing and venture investing. That just never existed before. It really didn't. You're starting to see crowdfunding actually certificates and actually degrees you can get from certain colleges when it comes to private equity and venture investing. This didn't happen 25, 30 years ago. So I think that crowdfunding as a concept is actually a great way to allow people to feel like they can actually take control of that part of their portfolio, maybe build something, however small, however large, but build something that could be value added to them or their kids or their grandkids or whatever. Nothing can remove the need to be careful and to be diligent and to diligence these things and literally look at every single company, everything you can find in that company. What I've seen, and again, not speaking about any one platform, but I've seen that the information that's provided, you have to get in 3 or 4 or 5 clicks to actually get down to the nitty gritty investment documents, understand the small print, make sure that you understand what you're signing. But a lot of it, you want to get past the fluff. You want to get past the kind of the hype of, boy, look at this new whiz bang electric bike, and we're going to put 1 billion of them across the country or whatever. But well, you got to look and say, well, there's like 20 other companies doing that right now. Why is this going to be different? I'm just using that as an example, not a specific example of any company, but spend the time, because a lot of times the crowdfunding raises, they actually give you enough time. They give you a fairly long window to actually do some research on these companies. The good thing about it is you don't have to spend a lot of money on any individual deal. So you're not going to, you have chance of losing a lot of capital on any individual deal. You can control that. And as you continue to invest and feel more comfortable, maybe you increase that amount over time, and then you funnel down, you focus on certain things. Again, back to your point, Danny, that you understand. But if crowdfunding can give people access to new ideas and new opportunities and help them learn about the business, I mean, I think that's always a good thing. Access is good. Yeah.
No, that's and really the idea of Trellis is to take the technology that we've come to see in crowdfunding and bring it into full Reg D compliant alternatives, where we can create great deal flow out there for the investors, for their advisors, for the broker dealers, in a platform that has a full diligence ready information. So everything they need from who's the management team, the overview, the background, the story, plus a full detailed data room. And then the key, as we've seen from the crowdfunding sites as well, everything's laid out in the same way each time. So when you're coming in, you're not learning for the first time where's this file in a data room? Where do I find that? Is this information here? Is it not? Do I have to call them up and find them? You learn how it's laid out, and now every deal you look at is the same structure and format, whether it's in real estate, it's technology, it's oil and gas, etc. Any of those things that are out there. So
I think just one final point on Trellis. I mean, again, I'm probably a little biased. I'm a board member. But we're involved with the company because we saw that. We see if you can make the lives of the issuers and the investors simpler by standardizing the format in which information is being presented, so that issuers literally have an easier time uploading their information. It's all managed, and you professionally put it together, and you allow them to actually present to the market in a very professional way. Look, entrepreneurs, whether they're technicians or they're salespeople that are trying to start a company, a lot of times they've never been through this before, right? They've never been through that process before. So having somebody help them try to compartmentalize the messaging that they're trying to create, and then professionalize it and make it look actually acceptable to the market, put it in a marketable format so it's actually readable and it's actually able to be absorbed by the market. That's incredibly valuable. And then for individual investors, going into a site and having a digital locker at Trellis and being able to look at 6 companies in a day, because you're looking at standardized presentations. So one person's marketing deck doesn't look like look different than another person's marketing deck. One person's financials might look complete, their cap table's complete, or maybe it's missing the cap table in the next company. That's a lot of work for an individual investor or a family office, or even an advisor. So if you can go into a Trellis platform and see the types of transactions you want to see in a standardized format, first of all, it creates an efficient process for you. You get the information you're looking for, and then because you will create a profile and say, these are the things I'm interested in looking at, and those are the only things you need to look at. So it's not it literally, again, it gets you closer to being able to go onto a Fidelity website and say, I want to invest in a large cap European fund. Well, they're going to show you the top 6 that they have, and you'll be able to look and see, get your information quickly, and make a quick decision. I think that's what Trellis is doing. Personally, I like the platform for both, because I think it adds value across the entire ecosystem of what's being trying to create. With an issuer trying to find good investors trying to find quality companies. I think that's what Trellis's platform does. It creates that meeting ground, and it actually creates a level playing ground for both. And they're doing it literally. The investor can do that in a completely blind fashion. They don't need to do this and expose themselves to the market. They can do this in a very comfortable atmosphere. I think that's very valuable on both fronts.
Yeah, that's great. Well, Steve, I want to thank you so much for your time. I want to thank our audience for joining us today. Anyone has questions, they can get in touch with us at Trellis. Go to our website at www.trellisplatform.com. You can get in touch with me directly. I'm D. Crowley, D for Dennis, Crowley, Crowley, at trellisplatform.com. So again, thank you, Steve. Thank you, everyone. We'll talk to you soon. We'll see you next month with our next webinar.
Thanks, Dennis. Thanks for having me.